The Central Bank of Nigeria has reopened the foreign exchange window to bureau de change operators, approving up to $150,000 in weekly FX sales to each licensed BDC. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. In a circular, the Apex Bank directed authorized dealers banks to sell foreign exchange to duly licensed BDC at the prevailing market rate, marking a major shift in retail FX supply. The move is aimed at boosting liquidity and easing pressure on the naira, as the gap between the official and parallel market rate recently widened by over 90 naira, the highest spread in 3 years. Under the new framework, banks must conduct full know your customers and due diligence check before transacting with BDCs. Sales are capped by 150,000 naira, $150,000 per week per operators, and must comply strictly with the existing BDC guidelines. The CBN has also tightened controls. BDC are required to submit timely electronic returns and barred from holding on to unutilized FX. Any unused fund must be returned to the market within 24 hours to curb speculations and hoarding. All transactions must pass through settlement accounts with licensed financial institutions. Third-party deals are prohibited, while cash settlements are limited to 25% of each transaction. The decision comes months after BDC operators complained of severe dollar shortage following the suspension of sales by the CBN. With this new directive, the Apex Bank is combining wider access with stricter oversight in a bid to stabilize the deepen the foreign exchange market. This policy signals a calibrated intervention by the CBN to cool volatility in parallel markets, as well as narrow the exchange rate gap. By injecting controlled liquidity into the retail segment, the bank hopes to reduce speculative pressure on the naira. However, the impact will depend on consistently supply, strict enforcement, and broader economic stability. If sustained, it could improve price discovery and confidence in FX markets. The federal government says Nigeria must cut back on borrowing and strengthen its domestic revenue base to secure long-term economic stability. The Minister of Finance and Coordinating Minister of the Economy, Wale Edun, stated this at the management retreat of the Nigerian Revenue Service in Abuja. It says the global financial environment has become increasingly difficult for developing economies, with rising interest rates, shrinking multilateral support, and growing debt service obligations. Available 2024 data shows that developing countries paid about $163 billion in debt service, far exceeding inflows from the development assistance and foreign direct investment. According to the minister, this trend makes continued reliance on borrowing unsustainable. Edun stressed that Nigerian fiscal sustainability must now depend largely on improved revenue mobilization, stronger savings, and disciplined investment. He noted that global shock, including COVID-19 pandemic and geopolitical tension, have increased borrowing costs and reduced fiscal space for critical sectors such as infrastructure, healthcare, and education. He identified ongoing tax reform as central to boosting revenue, improving fairness, and enhancing efficiency in the system. However, he emphasized that reform must be backed by strong compliance, enforcement, and public trust to deliver meaningful results. The minister added that Nigeria's revenue framework must become more resilient and less dependent on oil fluctuations, noting that economic growth, exchange rate movement, and inflation directly impact revenue performance. Meanwhile, the chairman, Senate Committee on Appropriation, has indicated that fresh borrowing may still be required to fund the 2026 budget, citing revenue shortfalls and significant development need. Also speaking, Executive Chairman of the Nigeria Revenue Service, Dr. Zach Adedeji, described the establishment of the service as a new chapter in the Nigerian fiscal reform agenda. He says the institution will be judged by measurable outcomes that strengthen public confidence and support national development. The call to reduce borrowing reflects concerns over rising debt servicing costs and global financial tightening, while shifting focus to domestic revenue is critical for long-term stability. The success of the strategy will depend on effective tax reform, improved compliance, and sustained economic growth. Nigerian Pension Fund are ramping up investment in infrastructure, with allocation jumping to 48.1% year-on-year to $262.6 billion in the first 10 months of 2025. Data from the National Pension Commission shows pension fund administrators committed 262.6 billion naira to infrastructure fund, up from 177.2 billion naira in the same period of 2024. Investment in corporate infrastructure bonds surged even faster, rising 130% to 36.6 billion naira. The shift reflects a deliberate diversification strategy as PFAs hunt for higher yields and long-term stable returns. Improved project structuring and a more supportive regulatory environment are also driving confidence in infrastructure as an alternative asset class. Despite the sharp increase, infrastructure exposure still accounts for just 1.4% of total pension assets, which stood at 26.66 trillion naira as of October 2025, leaving a significant room for expansion. Analysts say the move comes at a critical time when Nigeria faces an estimated $3 trillion infrastructure gap over the next 30 years, creating strong demand for private capital. For pension managers, infrastructure offers attractive long-term returns while supporting national development. Industry experts add that growing allocation to alternative assets, including infrastructure, private equity, and venture capital, aligns with the global best practice and could further strengthen returns. Expansion of the pension participation in the informal sector is also expected to boost the asset base. The surge in infrastructure investment signals growing confidence among pension managers in alternative assets, while exposure remains modest relative to total assets. The upward trend positions pension funds as the key players in closing Nigerian infrastructure deficit. Sustained regulatory clarity and strong project performance will be crucial to maintaining momentum. Nigeria posted a $10.8 billion trade surplus in the first 9 months of 2025 as exports of $44.06 billion outpaced imports of $33.23 billion, strengthening the country's external trade position. Data from the Central Bank of Nigeria shows that steady export growth averaging 0.76% per month, combined with a slight decline in imports, underpin the positive trade balance. The highest monthly surplus was $1.89 billion in June, while the lowest was $580 million in March. Export performance peaked in July at $5.85 billion, driven largely by oil, which accounted for about 84% of total exports. Non-oil exports rose to $6.93 billion, signaling early gains from diversification efforts in agriculture and manufacturing. Analysts point to the improved refinery capacity, a stable foreign exchange market, and target investment in agriculture as a key factor supporting exports and curbing import demand. Agriculture, particularly rice and soya beans, offers a short-term avenue to boost foreign exchange inflow, while manufacturing and value addition are critical for sustainable long-term non-oil export growth. However, structural and regulatory constraints continue to limit non-oil export. Bureaucratic delays in approval under schemes like ECOWAS trade liberalization scheme, limited processing infrastructure, and regulatory reach in agencies such as NAFDAC and SON are slowing the growth of manufactured exports. Let's take a quick short break now. We will be right back. Don't go away. Stay with us. Joining us, it's Business Point, where we extract the Nigerian economy and the government policies. Dangote Petroleum Refinery has cut its petrol gantry price by 25 naira per litre, lowering the ex-depot rate from 799 naira to 774 naira. The move takes immediate effect as the refinery ends its PMS lifting incentive, signaling a shift from volume-driven bonuses to a more stable pricing model amid evolving market dynamics. The price adjustments reflect easing cost pressures, improved operational efficiency, and growing competition from alternative supply channels, including imported cargoes and new modular refinery. Dangote, Africa's largest single-train refinery by 650,000 barrels per day capacity, continues to shape domestic fuel pricing and reduce Nigeria's reliance on imported petrol. In a separate development, the Dangote Group is exploring new investment in Burundi. Aliko Dangote, alongside former President Olusegun Obasanjo, held high-level talks with Burundian President Evariste Ndayishimiye to identify opportunities in solid minerals, power, agriculture, cement, and infrastructure. Dedicated technical teams from both sides are now mapping out priorities project to strengthen bilateral industrial and economic cooperation. The dual strategy highlights Dangote's approach, consolidating domestic market influence through competitive pricing while expanding the group's footprint across Africa. The PMS price cut signals a maturing downstream market as the domestic supply from Dangote moderate volatility and ease inflationary pressure. At the same time, strategic investment in Burundi underlines a push for continental growth, diversification, and long-term industrial influence. Together, this move strengthens Dangote's role in shaping both Nigerian energy and Africa's investment landscape. The Naira strengthened to 1,349.5 Naira per dollar on Tuesday, breaking low the 1,350 Naira mark for the first time since May 2024. Official foreign exchange data shows an improvement from Monday's 1,354.9 Naira per dollar. Analyst says stronger inflow, rising external reserve, and better liquidity in official markets are behind the gains. The parallel markets remain weaker at 1,443 Naira per dollar, highlighting a persistent gap between official and the street rate. The narrowing difference signals improving alignment in foreign exchange markets. Experts note that higher oil earning, remittance, and portfolio inflow have bolstered reserve, giving the central bank more room to stabilize the currency and the volatility. The development comes ahead of the Central Bank of Nigeria 304th Monetary Policy Committee meeting later this month, where policymakers are expected to review inflation, liquidity, and exchange rate trends. The Naira breaks below 1,350 Naira, shows growing confidence in official markets liquidity, while the parallel market remains under pressure. Rising reserve and improved inflow provide a stronger buffer for stability ahead of the MPC meeting. Nigeria has reinforced its role as a financial hub in West Africa, ranking as the second largest investment banking market in sub-Saharan Africa in 2025, just behind South Africa. According to the Sub-Saharan Africa Investment Banking reviewed by LSEG Data and Analytics, Nigeria generated $97.9 million in investment banking fee last year, an 8% rise from 2024, contributing nearly 20% of total regional fee revenue. South Africa led with an half of the region fee, while the Ivory Coast followed Nigeria in third place. The report shows a divergence in market strength. Nigeria's debt market thrived, boosting fee income, while equity issuance fell to $690.9 million, down to 27% from 2024. Despite the decline, several high-profile deals captured attention, including Prisco PLC with $163.7 million, follow-on offering, and United Bank for Africa combined $255 million equity raises. Mergers and acquisition involving Nigerian firm declined sharply, falling to 76% to $1.3 billion. Yet, Nigeria remained the fourth most targeted country in regional M&M activities, with consumers, staple, and energy sector leading the broader market. Domestic investment banks also made significant stride. United Capital PLC soared by 678% in proceeds to $84.3 million, ranking 10th regionally, while Cardinal Stone Partner Limited secured 11th place. This performance reflects growing domestic expertise and a stronger local presence alongside global giants like Goldman Sachs and Morgan Stanley. Nigeria's investment banking sector demonstrates resilience and evolving strength, while equity and M&M activities show cautious a booming debt market. Rising fee revenue and the growing impact of the local bank signals a maturing financial ecosystem capable of driving regional growth and attracting both local and international investors. All right, this is where we draw the curtain on Business Point today. Join me again next time on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.